welcome in our next guest, Financial Phil McCoy. He travels the country every weekend, it seems. Good morning, Philip. How are you?
Good morning, guys. How are you all?
We're well. In general, Gilstrap at least is.
Yeah, I'm good.
Yeah, because, John, you were sick last week, correct?
I sure was.
Yes.
And Rob has become a germaphobe, so he probably wouldn't allow you back in the office until you had a doctor's note. Is going to be my guess.
Well, no, I just had to wait for a week.
And if Rob is to get a sniffle between now and May, he's going to blame me for it.
It ain't going to be a sniffle he's going to blame me for.
It won't be running out of my nose. I know that. Based on the descriptions I got last week, it won't be running from my nose.
Oh.
I'm pleased to report Gilstrap has remained seated during the commercial breaks. That would not have happened last week if he was here.
But it is on leather.
Glad you're back, John.
Well, I'm glad to be here.
Well, Phil, you're stirring it up, man, which you shouldn't do. You need to be more like me, Phil, and not get into controversies and stirring things up.
Yeah, understood.
Right? That's what I think. Anyway. All right, another week has gone by, and we don't know where Aaron Rodgers is going next, Phil.
Don't know, and I'm getting to the point where I don't really care. I'll probably change my tune if he is to sign with Pittsburgh, and that still seems to be the heavy favorite. I'll change my tune. I'll live in fandom and say he's a great guy, but at the moment I don't really want him. I'd rather just roll with Mason Rudolph and let the chips fall where they may. At the end of the day, it doesn't matter which one of those two are the quarterback. I don't think they're going to take them to a Super Bowl. I'd rather do it with someone that wants to be there, which is Mason Rudolph.
I got a text on this last week from Matt Miller asking me when it looked like Rodgers was going to sign. He said, "What do you think about this?" And I said, "I think there's just a lot of drama that's probably unnecessary. If you know, pretty much Steeler fans are lined up not wanting Aaron Rodgers. But if he does sign and he plays well, fans are going to love him. And if he doesn't play well, if he doesn't play well, they're going to say, 'I told you he was horrible.'" And,
winning cures all.
And either way, it's a one-year Band-Aid. It's not. It's not the permanent answer. The guy's going to be 42 in December, so it's just whatever happens. In the day-to-day world of my life, who's the quarterback for the Steelers doesn't really change anything. And
how can you say that?
And as Chaz Palminteri greatly said in the movie A Bronx Tale, is Aaron Rodgers? I'm going to paraphrase. Is Aaron Rodgers going to pay your bills for you if you can't pay him? Right? No, he's not.
Never paid my bills.
He's not. Nobody on the Steelers is going to go, you know what, Rob's having trouble paying his bills this month. I think I'll help. They're not. So just why do you care that much?
Yeah, but why is the attraction? For the last 3 or 4 years, he has not produced. He makes a lot of headlines. He does a lot of makes a lot of comments, some appropriate, some not so. But on the field, he has not produced since he was playing for Green Bay.
People need a quarterback, and he can still throw a football.
Not that well.
We shall see.
Yeah.
Pretty well, considering his age, especially.
Considering his age, but that's not the question.
It's not like he's not noodle-armed or anything. He can still whip a ball around.
But you don't make these. You do not give excuses because someone's old.
Huh?
Yeah, that's right. My point is, if
you lost me on that one.
Yeah, if he can, you made the comment. Well, he's doing pretty good considering he's 41 years of age.
Yeah.
The 41 years of age should not be of consequence. It's whether or not he can lead a team to victory, and he has not proven he can do that for the last 3 or 4 years.
Well, was he on a bad team though?
Well, they brought him in. They did not say we're bringing you to a bad team, a good team. They brought him in.
He was brought into a bad team.
Yeah, and they said you're going to be the salvation. You're going to.
Well, he didn't say he was the salvation. They did.
They did, sure. But
that's not his fault.
Come on, Phil, jump in.
How can Aaron Rodgers control what other people say about him?
Bill, it doesn't matter. Let's do this. Speaking of Aaron Rodgers not paying our bills, let's rotate to a bunch of green numbers this morning on the S&P and the NASDAQ. We got some really positive things. It's going to help retirees pay their bills, and because Aaron Rodgers won't. And let's rotate to that because but what we've seen overnight, and we talked about it a little bit this morning, Rob, was we've got some hopes that the tariffs, not that they're going to go away, but possibly that they'd be more surgical, and that built on some hope from last week where the Federal Reserve had indicated that our economy is still on solid ground. So I think that kind of changed the momentum, if only for a minute. And again, we talked about that this morning. But at this period in the market cycle, what we've seen over the last week and overnight trading over the weekend is typical of two things. It's typical of a recovery, and it's also typical of a continued correction or bear market. It's typical in both of those, and which, of course, inserts confusion. But some of the tariff fears have subsided some. Number one, Jerome Powell had indicated that the tariffs would be minimal and we're probably overblowing what we think it would do to inflation, therefore is playing a very small role into what they would do in terms of decreasing rates further on this year. So we got some firm speak from him, if you will, and we got a bounce and then an indication. We've seen this change quickly, so I don't know why this would send our markets to the positive, but some indication that on April 2nd that maybe these tariffs are going to be more surgical instead of widespread, and therefore we get quite the bounce in pre-market, and that hasn't held up. But in pre-market, we got quite the bounce. But I'll take green where I can get it right now.
Yeah, Phil, we keep hearing these arguments, the tariffs not influence the market. I find that hard to believe. The alphabet soup.
I find that impossible.
Yeah.
Yes.
The alphabet soup we've talked about in times past is never really regarded. If the market goes up or goes down, it's always linked back to the tariffs.
Yeah, here recently the talk of the tariffs, because the talk and anticipation of the tariffs is another letter, if you will, in that alphabet soup of reports. The PCE, we get one of those this week as well. But the CPI and the PPI and all these different inflation reports, well, the tariffs are the fear of that they are inflationary. So depending on how severe they are, would that cause, it always goes back to the Federal Reserve with me, I know, but will that cause Jerome Powell or the Federal Reserve Board to slow down on decreasing rates or prevent them from decreasing rates at all? And that's where a lot of our market reactions have come from.
If the market is looking long-term, Phil, why does it react so quickly in the short term? These tariff commentaries that come about, I mean, it's not like Trump hasn't been president before, right? You know that if he says something today, he could say a variant of it in 2 days and the exact opposite in a week. So what's with the hyper reactions on it?
Markets are predictions. So when we say markets are long-term, investors are long-term. I would change that statement a little bit and say investors, our investors anyway, what we do is the long-term. Markets do kind of predict and look forward and try to play things out 3 to 6 months. As we know, like things that happen in the economy, sometimes we don't see the impact of those for 3 to 6 months out. So that's what the markets are trying to do to get ahead of that. And John always reverts back to, and he's correct, that markets will always revert back to corporate earnings. So corporate earnings is always a focus, even if we don't talk about it as much because some of this stuff's swirling underneath of it. But markets are a predictor of what we're going to see 3 to 6 months out. Think back to, and I'm not glad that COVID happened. I'm glad our markets behaved the way that they did during COVID, because a lot of people remember that, and they remember what they were doing in April of 2020 when there wasn't any clear indication of when we could go back out and spend money and congregate and get together and go to baseball games and football games and into the movies and restaurants. None of that was clear, although our markets were soaring and doing really well because it was looking forward. And what it saw in April of 2020 and part of March of 2020 and May, but what it saw was consumers that had money because of easing from the Federal Reserve and some of the stimulus programs that were out there. So they saw a consumer that had money, a hungry consumer because they hadn't been able to spend money. And what had proved out, the market saw it, what had proven out was someone that was willing and eager to spend it almost to a fault. They continued to spend. But in April of 2020, our market soared while we were stuck at home because it was looking 3 to 6 months out.
I think there's real danger when investors, casual investors, not the professional folks. Yeah. And I consider myself a casual investor. Like my life is tied up into these things, but I trust other people to make the important decisions for me because I don't really understand what I'm doing. But you hear these stories in the runaway good times when people think, okay, let's invest, and we're going to spend a lot of money on the really hot things. There was an article in the Wall Street Journal last week and about the the over enthusiasm on ETFs, exchange traded funds, and then people were doing leveraged ETFs.
Yes.
And it hasn't gone so well on that. Could you talk a little bit about that?
Yes, leveraged ETFs, and basically what a leveraged ETF is it aims to give you 2, 3, sometimes even as much as 5. Those are rare, but even as much as 5 times an underlying indice, the return of that underlying indice. Now they do that by borrowing money, and they also do it with options trading and futures trading. But what their goal is say, hey, look, if let's say S&P 500, for example, if it goes up 1% today and you have purchased a 3 times leveraged ETF, you're going to get a 3% return on that day. Now, one thing to note with leveraged exchange traded funds and the like is they are short-term investments. So those reset on a daily basis. They cost a lot of money because the fees are really high because they're borrowing money, so there's interest to be paid, or they're purchasing future contracts or option contracts, which come with a premium. So therefore, those are flowed through to you. And then they reset on a daily basis. So they're not long-term. Those are meant to be done for 1 or 2 days, and that's about it. They're very short-term. But the downside to these ETFs is you're looking at it and say, hey, I'm really bullish, for example, and I want that 3% return on the S&P. Well, okay, you're going to pay a high premium to get that 1% on the S&P, but what if it goes down 2%? Well, because of that, now I'm down 6%. And I paid a lot of money to get that just because that underlying indice. So it has ratcheted up the volatility and their short term because of their nature of resetting on a daily basis. So at the end of each day, that ETF resets and says, hey, we're going to play this game again, yet again tomorrow. So our approach toward that is if you're looking for more volatility, if you're looking for higher returns, let's drill down into that S&P. Let's drill down into that asset allocation and find a sector or an idea, or even in some cases even a mutual fund that can be held for long term, and the fees are more in line with what you should be paying, and not resetting every day, so you don't have to worry with buying and selling. So on top of, and it's something to remember too, is these ETFs have high fees. So therefore, you're not getting the return really that you're signing up for because of the high fees. Now, you may get to 3%, okay, or 6% or whatever it may be, but then your fees are subtracted out of that. But because they're short term, you're also buying, which costs money, and then you're also selling those, which, by the way, costs money. So you've got those fees on the end of that as well, where it could be achieved in a different way with a longer term approach. But they are dangerous. They are very dangerous because of the leverageability on them. Now, on the flip side to that, there's also leveraged ETFs or investments that aim to give you the opposite of what happens in a particular index. Use the S&P again. So if the S&P goes down 1%, I will gain 1%. That's because they have sold components of that S&P short. But yet again, that is a move toward the downside of the market, which only happens about 20 to 25% of the time. So you're gambling on something that happens 1/4 of the time. And on top of that, now I'm still paying those same exact fees that I would when I was trying to get the upside of that index. So they're very volatile. They're very expensive. If you're a day trader, you enjoy doing that. You don't mind paying the fees. But for long-term strategies, leveraged ETFs should not be touched.
You like that answer, John?
I do. The whole notion, there was an investment guru back in the 80s. I think his last name was Givens, although I shouldn't say that if I'm not sure. And he was all about leveraged investments. You know, he was all about. I think that's the term, right? Where you get calls on the
calls and puts.
Yeah,
options.
Options.
Calls and puts are options. Those aren't necessarily leverage. Leverage comes into play when you're borrowing something. So
yes,
if you sold something short, that's a different story. Selling something short, you actually are borrowing. You're borrowing that stock or that exchange traded fund. You can do it on exchange traded funds as well. And because I sold it short, what I'm doing is I'm borrowing said investment, insert whichever investment, stock or ETF. I'm borrowing that in hopes that I borrow it, I sell it, I have the money, in hopes that that stock or underlying investment drops in value. When it does, I'm going to buy it back. And the difference in those two numbers is the profit for the short seller. You see those a lot in hedge funds, but that is leveraged because I have borrowed that underlying investment. The risk in short selling is if I bought a stock for $20 a share, just as an example, the most I can possibly lose is $20, because if it goes to zero, then I've lost $20. However, if I've sold that stock short, that $20 stock short, thinking, hey, it's going to drop to $5, so I will make a $15 profit on this if it happens, less the fees I have to pay for the borrowing, well, that would be all well and good if it does drop. What if that $20 stock becomes NVIDIA or Tesla or Amazon, and it goes to $400 in the time frame that you're selling that short? You have just lost $380 a share. And in theory, there's no end to how much you can lose on short selling. So short sellers protect themselves by using these other options, calls and puts, and that's where those come into play. And there's people on the other side of those as well. But those get into short selling. It's something we don't like to do. Covered calls, protective puts, we do those for individual positions, especially large positions, and those can be income generating, as almost like a rent, and they can also provide downside protection, almost like an insurance. But of course, within insurance, there's a premium. So you on one hand, you can straddle a position, or if you will, and say, hey, I want to put in a top end on it and get some rent, and on the back end of it, I want to put a floor in or some sort of protection. Those are protective puts. Those aren't risky at all as far as losing money. The risk comes in what if it goes so high and I have to sell it at a certain position. So the risk is nowhere near. You're actually reducing your risk when you do a straddle with calls and puts.
You mentioned hedge fund in there for a moment, Phil. I've got a friend of mine who's a retired Wall Street dude, and his daughter now works for a hedge fund, and read a report that said the vast majority of hedge funds underperform the S&P 500 market index. And she works for the world's largest hedge fund. So what is the attractiveness of working, not necessarily working, because I'm sure she's making a ton in commissions. What is the attractiveness of investing in hedge funds if they don't even do as well as just buying the S&P 500 index?
A lot of times they're short term, and they can provide different things that you can't get with just investing in an index. Where we kind of shy away or make an ugly face at a hedge fund is the liquidity of them, because you have to put the money in them for quite some time. So you're placing dollars into these hedge funds. Most of the time you have to qualify as an investor, as an accredited investor, to put money into these hedge funds. But the liquidity of it, we're not fans of locking people's money up for certain periods of time, because the financial planning aspect of what we do here, that is a focus on what we do here, but we don't like to lock people's money up because of the unknown. But hedge funds do provide in some cases, downside protection that you can't simply get by purchasing or doing it on your own, the S&P 500. Now, you could do it with calls and puts and putting floors and ceilings in on it, but hedge funds do that for you, and therefore you pay the price for it.
Phil, going back to the leverage ETF, and I want to applaud John Gilstrap. He raised the subject over the weekend, so we had a chance to do a little bit of research on it. But the way that you were describing it early about the profits being covered by other investment, that strikes a little bit like a Ponzi scheme. What did I miss in your discussion?
Not a Ponzi scheme. The other investments that are creating this are future contracts and option selling and sometimes borrowing. So they may invest in, just on the simplest level of a leverage ETF, you may have placed $100 in, but what that exchange traded fund has done is actually purchased $200 of that underlying investment for you to obtain the return on that, on the $200 that they invested. The way that $100 is made up, that additional $100, is by borrowing. So therefore, you're paying interest or a fee to borrow that money inside of that. They're just doing it for you. So you're not saying, hey, Bill Stubblefield's borrowing $100 to buy 2 shares of the S&P 500. That ETF is doing it for you. So it's not necessarily another investment. You're going all in and then some. If you were playing cards, you're doubling down with a leveraged exchange traded fund.
And is there actually a person with a heartbeat that is making these trades, or is it a computer generated thing?
It's a person that's come up with the algorithm, and there's a person or people that's behind it looking at it, but they have done this with a underlying index. So that index, the only thing they have to do is make sure it still mimics the index as the next day begins, which of course costs money, and that's one of the reasons why it's short term.
What are we waiting for news-wise this week, Phil?
Well, I'm going to give you some internal news. News-wise, we get the PCE report, which is the Fed's preferred measure of inflation. Hopefully that continues to trend down. But I want to give you some internal news that we're here at the Mirius Group. I don't like to brag, but I like to brag on Tyler Butler, who just passed his CFP exam on Friday, and that's quite the accomplishment. That's 3 of us now in this one office that are all certified financial planners who put in a ton of work, a ton of study time outside of the regular business day in order to pass that exam. You have to have a lot of criteria to do that: apprenticeship, time in the business, and of course a vast knowledge of not just investments but the financial planning aspect of what we do and the discipline. And we always do talk about that we hang our hat on financial planning. Now there's 3 CFPs under one roof right here in Martinsburg. You don't see that in a small town like we have. You don't see that often, where the entire building of advisors are CFP. So super proud of Tyler. He's a young guy, and he's really the future of our office. And you have John, who we tease and call him an old man in his mid-60s. You have me that's not yet reached 50, and you have Tyler that's in his 30s. So we're all spread out, and we have the same have the same accomplishments and acknowledgments as far as our education is concerned.
How long does it take to get that accreditation, Phil?
Well, the study time for it varies based off of. Now, you could do it as most people. It takes a couple years of study time. You can do it quicker if you're not currently working full time. You can do it quicker, or if you don't have children or what have you. But there's a certain amount of hours that you also have to have under apprenticeship. And I want to say that's 4,000. Don't hold me to it, because mine was a few years ago itself. And if I took the test again, I would miss that. But the apprenticeship, it's vast hours that you have to have.
How do we get in touch with you today for more information, Phil?
You can reach us at 304-263-4343 or stop by and see us with an appointment at 1270 Winchester Avenue right here in Martinsburg.
Thank you, Phil. Have a great day.
Thank you, guys.
Thanks, Phil.
Catch 2 Minutes with Phil each weekday morning at 6:38, replayed at 7:38, recapping the day before and previewing that day's market.